Kay Properties recently hosted its annual Kay Investor Day in Los Angeles, California. The event attracted nearly 200 high net worth investors from across the country who wanted to learn more about the investment vehicles as Delaware Statutory Trust, 721 UPREIT offerings, and opportunistic and income-oriented funds. Investors were able to hear multiple in-depth panel discussions from many of the nation's top real estate sponsor companies. They also heard keynote presentations from members of the Kay Properties team of DST experts and enjoyed networking opportunities among the accredited investors. This video highlights the opening remarks made by CEO Dwight Kay during this year's Kay Investor Day conference. Highlights included how to evaluate and select the right sponsor for your 1031 exchange needs, and how Kay Properties conducts due diligence on DST and 721 UPREIT offerings to help investors make informed decisions. Without further delay, let's dip into Dwight Kay's opening remarks from this year's Kay Investor Day.
We really appreciate each and every one of you coming out here and joining us today from all parts of the country. And so thank you guys so much for joining us. Shay kind of went over a little bit about what we're going to be talking about today. I'm going to give a few opening remarks, but first I want to, obviously welcome you guys, but then also provide some honor. This event and kind of who we are wouldn't be in existence if it wasn't for a few key individuals and groups of people. But first and foremost, I do want to say thank you to my Lord and Savior, Jesus Christ. He got a hold of me when I was 20 years old, and he completely changed my life. So without that, none of us would be here right now. And so I just want to give honor there. Thank you. Second, I have some clients in the room that for nearly 20 years, they've been investing with me. So for Kay Properties clients, we have thousands. I think it's up to like 4,000 clients now nationwide. You just really appreciate and want to just thank you for your support, your belief over the years with us. So current Kay investor clients, thank you so much. And then third, future potential clients. Thank you guys for coming out here and wanting to hear what we have to say. This is an educational event. We're here to educate. That's what we do at Kay Properties. That's kind of how we started at Kay Properties, is educating people on their potential options. So, future and potential clients, we really appreciate you guys coming out here and allowing us the opportunity to potentially work with you. And then also for our sponsor table here, the DST sponsors, many of them I've worked with for, 10, 15 plus years. Really appreciate you guys coming out here and being a part of today's presentation. This is just a really great opportunity, for us to have you in front of our clients and talk about your strategies, So thank you so much, everybody. Really appreciate each one of you guys coming out. I've got a list here. So, first off, our diamond sponsors, which is our top level, Capital Square. Lewis, thank you so much. You've been amazing over the years. We've worked together since, I think, 2011. And thank you so much. So Livingston Street Capital, Peter, thank you, Peter, for joining us here. And then Riva, Steve Sadler, thank you, Steve, for coming out and sponsoring as a diamond sponsor. Platinum sponsors, we've got NextPoint, Brian, and Dustin. Thank you guys for coming out. We really appreciate you guys flying in from Texas. And then our gold sponsors, Cantor Fitzgerald, Starboard Realty Advisors, Pasco, Exchange Right, and Blue Rock. Thank you to our gold sponsors. And then also, this is kind of unique. I kind of just learned about this. Traditionally, we do have clients throughout the country, thousands of investors throughout the country. Pretty much, probably not all 50 states. There's probably one or two that we haven't helped a client with their 1031 exchange yet. But I found out that there was a lot of investors flying in for this, So we have a list of states here, obviously Southern California, Los Angeles, Orange County, San Diego. Thank you for clients that drove in. Even the ones from LA, it could take a couple hours to get here. So thank you. We appreciate it. And then also from Northern California, I have clients that drove down from Northern California. So thank you so much for that. But then also the states that are represented here today at Kay Investor Day. We have clients from Texas, flew in from Hawaii, flew in from Illinois, North Carolina, Nevada, Arizona, Florida, Connecticut, New York, and Colorado. So that kind of blew me away right there, and we just really appreciate each and every one of you for taking the time to come out and learn with us. So thank you so much. As I was thinking through Kay Investor Day, and we knew we wanted to have the sponsors there to talk about their strategies, what they're seeing in the marketplace right now, I was kind of going back over my nearly 2 decades working in this space, real estate, investments, DSTs, and went back even my first DST that I purchased was in 2008, prior to the financial crisis. So that was the first time that I invested in a DST, and that was back before most, 80% of the sponsors that offer DSTs in this industry right now was before they even existed or knew what a DST was, right? So been doing this for a long time, lots of DSTs. I think personally I'm at over 50 now, right, that I've invested with many different sponsors in the industry. And so like Shay was saying, that experience and that, wherewithal from understanding how the sponsors work, how the properties work, how the different DST strategies work, we're really trying to pass that along to our investors. And the same for on the 721, I counted it up, I've done 15 721 exchanges, personally myself. Obviously we've helped many, many clients, but trying to go through all that and go, well, what could I be the most impactful for our investors today at Kay Investor Day? And I came up with 5 different things, 5 different bullet points that essentially are, guiding principles and, philosophy that we've put together over the nearly 2 decades in this DST space that we kind of, want to impart on you. So let's see here, next slide. That's me. So access and diversification is crucial. That's point number 1. So like Shay was saying, when I first started in the DST space, it was really, as an analyst, right, at a broker-dealer, going through the DSTs, reading the appraisals, property condition reports, the environmentals, the zoning, looking at the pro formas, understanding how they were underwritten, the cash flow analysis, doing stress tests, just looking at the deals from a real estate standpoint, and then from there, digging into the securities offering, trying to understand, does this make sense? Is it reasonable? What are the potential benefits? What are the potential risks? Really digging in, that's how I cut my teeth, and so we're still doing that today. But what I saw back then was that investors, oftentimes working with their wealth manager or financial planner, only had access to 1 or 2 different DSTs, okay? And so they're coming into an exchange, a 1031 exchange, and they have a great relationship with their wealth manager. And they've worked with them for 20 years on their stock and bond and insurance portfolio. And then all of a sudden they have an exchange for $1 million or $5 million or $10 million. And next thing you know, the financial planner is saying, oh, real estate, I can help you with that too. Here's the best deal in the market. And I looked at that and kind of thought, from my real estate background prior to that analysis background, I was on a multifamily brokerage team in San Diego. I kind of, compared that to when investors would come to us back then looking for, I want to invest in apartments, I want to buy an apartment building. As the brokerage team that I was on, we didn't go, here's the best deal in the market, buy this one. No, we pulled the market, saw what's available on and off market, provided those to the investor. Here's 15 different deals that make sense based on your criteria. And then the investor was able to compare and contrast and really dig in and understand which one of those buildings made the most sense. Or, if you're buying a single family home, maybe for yourself, a family member, maybe just as a rental home, and you talk to an agent, say, I want a 3-bedroom, 2-bath, I can go up to this. They don't just show you 1 or 2 houses, right? They're gonna show you the market. They're gonna give you options. You're gonna get to understand the market, right? And I compared that to, that in the real estate world to what was going on in the DSTs, because DSTs, they're real estate, but it's also a security. You have to have the right licensing. It's not easy to get the licensing. And so, the wealth managers, they had the right licensing, but they didn't understand real estate, and they only had access to 1 or 2 deals. And so I thought to myself, investors need choices. Investors need options, right? When you're in a 1031 exchange, everybody's goals and objectives, they're different. Everybody's risk tolerances are different. It's not a one-size-fits-all approach in the DST space. You need to have options. And so my first point is that access and diversification is crucial. It's crucial to investors to be able to have access to a plethora of opportunities when you're in a 1031 exchange so that you can understand how everything looks, how everything stacks up, compare and contrast the sponsors, look at the potential pros, look at the potential cons of the offerings, and decide for yourselves, right? Everybody's different stages of lives, different circumstances. And so that's what we did with the K Properties platform, is we brought together 25 of the different DST sponsor companies in the space, which we have about 5 of them here today to talk with you, onto our marketplace. And it kind of hadn't been done before. People had different broker deals that have 1 or 2 offerings, and here's what you get to choose from. And that's where we created the marketplace, and it's been really, really widely adopted by our investors nationwide. And so you're going to get to see, when you log into the K Properties marketplace, you're going to see all those sponsor companies, typically 25 to 30 different sponsor companies, all their offerings. We have 20 to 40, sometimes 50 different offerings available. Everything's different. There's different asset classes, different structures. We have debt-free, we have leverage, we have highly leveraged, we have all the asset classes, and from multiple companies. So you as an investor get to understand the market, understand what's out there, understand the different strategies. And with your K advisor, you're going to be walk you through the pros and cons and the risk factors associated. So that's what we did, and it's been incredibly successful for our investors to show them what they have available. And that diversification piece, again, like Shay was saying, is the way that investors are able to potentially protect themselves from a catastrophic situation, right? There's groups that right before coronavirus did a bunch of hotels, right? Well, hotels in coronavirus, leisure travel, as well as business travel, really shut down, okay? And those investors suffered because they were told, well, this is the best deal, and they went all into that deal, right? So the diversification is a way that you can protect yourself, and that's how I invest. Like I said, I have over 50 different DSTs for exchanges and cash investments that I've done over the years, since going back to 2008, with some of these sponsors at the table here. That's, you're trying to choose the best investment. It's kind of like trying to choose the best stock on the Fortune 500 list. Nobody has any idea which one's going to be the outperformer or the underperformer, okay? And so building that broad-based diversified portfolio, although diversification doesn't guarantee profits or protect against losses, we believe it's the prudent thing to do, okay? So access, diversification, it's crucial. Investors need more than 2 to 3 deals. So next, theme number 2 is understanding the risks of leverage, right? Going back to early 2010s, right? At that time, there was maybe 1 debt-free DST available per year. Everything else was leveraged. Everything else had a 50, 60, 70% loan to value on it, okay? And when we had clients that were coming out of exchanges and they had already paid off their buildings and owned them free and clear, and they were at a stage in their lives where they didn't want to take on any undue risk, okay? Those investors needed something better than a 50% loan to value CMBS DST deal, right, that had some potential risk there. It's not that that's bad, and that can work for investors that need to replace debt in their 1031 exchange. They'll purchase equal or greater value, okay, rule with the 1031 exchange. And on our marketplace, we have leveraged DSTs. We have properties that have loans on them. But for those investors that didn't need the leverage, there really wasn't that many debt-free options available. And so it was, about probably 2014, 2015, we started, our volume got to a point where we were the biggest in the industry. And we went to the sponsors and said, hey, we'd love for you to work with us and create a debt-free DST. And traditionally, real estate investors, they don't understand that. They love leverage. They love the debt. They love the opportunity of juicing potential returns and juicing potential fees. Because on a leveraged DST, you can have a higher fee structure, okay? So the sponsors didn't understand. It was like we were talking a different language. And we went to them and we ended up convincing a couple of them because they knew our volume and the amount of clients we had and the amount of 1031 investors that we were placing equity. And we were able to launch our first kind of debt-free custom for K Properties. And it was wildly successful. We did probably $600 million of debt-free DSTs for our investors over the next 3 or 4 years. We still, had the leverage ones for clients that needed to replace debt, but for those that didn't want that risk, we had the debt-free. And we're blessed, or we're honored to be able to have helped so many people, because back then, again, 99 out of 100 DSTs was leveraged. Okay, today, if you look at the DST industry, anywhere between 30 to 50% of the DSTs from the sponsor companies are debt-free, okay? And that was really because we kind of at K Properties, because of our scale and because of who we are and the amount of capital we're placed, the influence we have on this industry, we were able to force the hand of many of the sponsors, and it changed the trajectory of the market. And now, as inflation has crept up, as interest rates have risen, as there's problems throughout the economy, a lot of investors that we didn't even work with, they're now in debt-free DSTs, and we're thankful that we could have actually got them into a situation where they're protected. Because if you look at the news, there's a lot of defaults on loans right now, right? Commercial real estate default, just type it into Google News, and you'll see the biggest names in the real estate industry worldwide. They're giving back properties. One of them, I'll keep the bank unnamed, but I think they bought the property in Manhattan for like $450 million in 2018. They just sold it for $9 million. So we're really able to protect our investors through that debt-free nature. Now, like Shay was saying, just because you're debt-free doesn't mean it's a guaranteed investment or you can't lose your money. Real estate values can go up and real estate values can go down. Right? Tenants can pay their rent, tenants cannot pay their rent. There's no guarantees. So we always, if you're working with the K Properties team, we provide you a private placement memorandum, and it's going to go through the business plan and the risk factors of each property. So you get to understand it. So there's never any guarantees, but if you can remove the leverage component from the transaction, we believe that you're really lowering your risk in a meaningful way. You'll never be foreclosed on. You'll never lose the property to a lender, okay? You'll have no cash flow sweep risks as found in a lot of leveraged commercial loans. So being debt-free is really, really important. So utilize debt-free DSTs when possible is my advice. That's what I do. That's what we advise our clients. If you do have debt to replace, don't over-leverage. Let's replace the debt, okay? That's the second piece there. And then third, some of our clients come to us and say, hey, I've already paid off my property, it's free and clear. I want to do the bulk of my equity in a debt-free DST portfolio, but a piece of it, a relatively smaller amount of it, I want to put into a leveraged DST because I've already fully depreciated my asset and I need some tax efficiencies. And so they take a measured approach to utilizing debt, getting into 10 or 15% of their overall exchange dollars into a leverage piece to enhance their tax efficiency. So, and that's fine too, but understanding the risks, that with the leverage, that's something that most don't go into, most don't understand because again, most people that are experts in the DST space, a lot of the big wirehouses, they're selling them now, their stockbrokers are selling them now. They've done one or two in their entire lives. You guys saw we've done over 9,000 DST and 721 transactions at K Properties. So when you do something 9,000 times, you kind of get good at it, right? So again, but we're blessed and we're really thankful. So understand the risks of leverage, don't over leverage, utilize the debt-free when you can. Loan pitfalls to avoid. If you are using leverage, if you do have to go into a DST or a 721 that has leverage because you have to do the debt replacement, purchase equal or greater value per the 1031 IRS rules. Some loan pitfalls to avoid, okay? First off, floating interest rate loans. How many of you guys here remember the ARMs, the adjustable rate mortgages, right? From 2008, people got into these things because their monthly payments were lower and they had a job. And then all of a sudden when interest rates rose, their monthly payments doubled, and they didn't have a job. They lost it in the recession. Boom, they were foreclosed on. Same thing in the commercial world. A lot of loans are adjustable rate mortgages. They're floating rate debt. It's much higher risk. It's great when you can save money when rates are super low, but then over the last 2 years when rates shot up, that's where you're seeing defaults, okay? A number of the 721 UPREIT DSTs and the final destination REITs have very high exposure to floating interest rate, adjustable rate mortgages, okay? You want to be careful with that. I wouldn't invest in those personally. We have some. We'll walk you through the risks, okay? And that's what our next session's on. It's on 721 UPREIT DST Due Diligence 101, okay? But floating rate, adjustable rate mortgages, be careful, don't do them. Shorter, 3 to 5 year loans, be careful, don't do them. We really like 10-year fixed rate financing if you have to replace debt. It's gonna, trust us, you'll thank us when the time comes, if that happens. A lot of people said, wow, I can do a 3-year loan or a 5-year loan and have a much lower rate than a 10-year loan, and then all of a sudden rates jumped up and their rates went up as well. And so just be careful with the loan pitfalls to avoid. That's another one there. Higher risk asset classes. So traditionally, DSTs, it's been multifamily, industrial, small bay industrial, multi-tenant retail, essential net leases, last mile distribution facilities, kind of the bread and butter of commercial real estate, okay? Some of the higher risk asset classes would be your hospitality, right? Your student housing. What happened during coronavirus to the universities? They shut down, right? And so students didn't need to live off campus in student housing anymore. They went home. That was a hard time for certain investors. And so understanding these risks of these kind of more esoteric, just kind of higher risk asset classes like these hotels and student housing, doesn't mean they're bad. They could do really well, right? And there's some great operators, and we have some of them. But ultimately, it is something you should be aware of the risk. And we're going to walk you through that risk. But understanding the higher risk asset classes, their risk awareness for a reason, okay? How much time do I have, Vincent? 5 minutes, great. Okay, 721 UPREIT offerings. That's what our next session is on. Due diligence is paramount. Just because a wealth manager says this is a great deal does not mean that you should plop your entire $1 million exchange into that one DST UPREIT. We see wealth managers putting clients, and we have thousands of clients nationwide. We've inherited a ton of clients from people that got into this with their wealth manager that didn't know what he was doing. And he put their entire $3 million exchange into one offering. It's really, really important that the 721, like I said, I've done 15 of them. It is a really great tool, but you do have to peel back the layers of the onion and understand the risk, understand what's going on, or else you might wake up one day and not be too happy, right? And so doing your due diligence on the 721, that's something we have teams of analysts at K Properties, not only on the 721 DSTs, but the entire menu of DSTs. Our teams are going through all the things I mentioned before, the appraisals, the underwriting, the assumptions, environmental, offering docs, looking at the 721 UPREITs, how they're structured, so that you can understand what makes sense for me and my family. And you might still like something, go, ooh, I don't like that, but I still want some exposure to that, but you're not putting your entire $5 million into that one offering that has a glaring risk factor. You might go, the likelihood of it happening is pretty low, but I do want to get 15% exposure there. That's what we walk you through at K Properties so that you don't over allocate. I mean, it's crazy. Wealth managers, if you have $1 million stock portfolio, they put you in a broad-based portfolio of stocks. They don't go, this one company on the Fortune 500 is what you should put your $1 million in or your $5 million, right? They diversify you. But then that same wealth manager gets his hands on your 1031 exchange and he plops your entire $30 million into one DST UPREIT, one program. That's just not the way to invest when it comes to stocks as well as real estate and the DSTs. The whole point of the DST is to build a diversified portfolio. Okay, so peeling back the onion, the 721s can be a great tool, and we have them. We really like to have fully optional 721s, okay? There's 4 721s and there's fully optional 721s. Full optionality means that when that DST is called into the REIT, you get to analyze the REIT. Does this REIT make sense for me? Do I like the debt levels? Do the financials make sense? You get to look at that time, and that's full optionality. If you don't like it, then you just do another 1031, where with the forced 721s, unfortunately, you're making a decision today, and then in 2 or 3 years, you're forced to go into that. Well, what if the management company of that REIT shifted styles and went from, the lower risk, multifamily, industrial type real estate, and then jumped into hotels in a big way? Some of the larger 721 UPREIT DST companies, these are giant institutions. They've traded hands. These big companies have been sold multiple times, okay? We just saw that with, who was it, Dustin, bought Bridge? Apollo bought Bridge. Massive transaction. So a new manager comes in and has a different idea for the property. If you're in a forced 721, it doesn't matter. You don't get a decision. So we really prefer fully optional. Again, you want to look at the final destination REIT financials and debt levels, really with a critical eye. Understand what's going on. Peel back the onion. That's what our analysts do. We can walk you through those. It's not to say that any of them are bad necessarily, okay? But you have to understand what's going on, and that's what we're here to help you with. And then lastly, tax protection agreements. That's something that is really important. Essentially, if you're in a DST that gets called into a REIT, if that REIT ends up selling that DST, even though you're diversified in the entire REIT, if they sell that DST building and don't internally within the REIT do a 1031 exchange, it's as if you had a failed 1031 exchange, okay? And your capital's tied up in the REIT, but you got the tax bill as if you just sold the property and didn't do a 1031 exchange. So what some of these REITs do is they do a tax protection agreement. This is a TPA, we call it. It essentially is the REIT saying, hey, listen, Mr. and Mrs. Investor, if we sell this DST and we don't do a 1031 exchange, guess what? We will pay your federal and state capital gains taxes, the tax protection agreement. Some of them are just for 2 to 5 years, okay? One of the ones we have is 20 years. We like the longer the better, okay? A bunch of the big 721 UPREITs don't have a tax protection agreement. If you type in on a global search on the PDF or the DST private placement memorandum and type in tax protection agreement, you're gonna see we are not offering you a tax protection agreement. You'll see that in the fine print, okay? These are giant financial firms with myriads of lawyers, okay? They're protecting themselves, and if things change, it can really affect an investor if you're unaware. If you're just trusting a financial wealth manager that does your stocks and you've played golf with him for 20 years, and then he says, this is a great company, look how big they are, and you plop your entire exchange into that 721 UPREIT, it could be fine, trust me. And we might still work with that group, but on a diversified basis and with an eyes wide open mentality. And Tim's gonna go into that too. I just really wanna thank you guys for coming out here today. Thank you so much for taking the time out of your busy days, joining us, and I hope you have a really great time and learn a lot here at K Investor Day. So thank you so much.